Let's talk about a number that could make or break your next equipment loan, line of credit, or business expansion: your debt service coverage ratio, or as the bank may like to call it, the DSCR. Now, don't let the acronym scare you. This isn't a Wall Street thing. This is a job site reality. Because if you're carrying any kind of debt, and these days, who isn't, you need to know if your business is pulling its own weight. So, what is it? The DSCR equals your net operating income divided by your debt payments. So, you take your operating profit, that's your income before you pay interest and taxes, and divide it by the total debt payments your business owes this year. That includes loans, equipment notes, line of credit payments, even that skid steer you financed last spring. Let's say your business makes $150,000 in net operating income this year, and you owe $100,000 in principal and interest payments. That's $150,000 divided by $100,000 equals 1.5. So that would mean your debt service coverage ratio is 1.5. In other words, that means for every dollar you owe, you got $1.50 to cover it. Now that's a business that can carry its own load. So what's a bad number? Now let's say the numbers flip. Your operating income is $90,000, but you still owe $100,000. So that's $90,000 divided by $100,000 equals 0.9. That means you don't even have enough income to make your payments. You're about 10% short, and the bank notices. That's when the red flags go up. That's when your stress goes up. That's when you start moving money around like a magician just to cover the monthly nut. So what is a good debt service coverage ratio? Most lenders want to see a DSCR of at least 1.25. That's enough cushion to cover your payments with a little breathing room. So here's a quick read. If you're at 1.5 or above, that's healthy and strong. If you're between 1.25 and 1.49, well, that's acceptable. If you're between 1 and 1.24, you're skating on thin ice. If your ratio is below 1.0, you're underwater. Now, you might still get approved if your debt service coverage ratio is low, but you'll pay for it in interest or oversight or personal guarantees. So, what does the debt service coverage ratio really tell you? Look, debt's not always bad. Sometimes debt helps you grow. But it's like rebar. It's only useful if the concrete can hold it. Your debt service coverage ratio tells you if your business has the muscle to carry that weight without buckling. I've seen contractors get into trouble because they're chasing growth, leasing new trucks, buying equipment, taking on financing, but the profit isn't keeping up with the payments. Now they're working just to feed the debt, and that's a trap. Let's talk about how to improve your debt service coverage ratio. Here's the blueprint. Number one, increase your operating profit. If you can increase your gross margin, reduce your overhead, or stop working jobs that just break even at best, you can improve that operating profit. Number two, you can pay down some of those high debt obligations. You can knock out some small notes, refinance to longer terms if you need a little bit of short-term breathing room. Number three, you should avoid stacking debt without a plan. If you're financing growth, make sure the cash flow shows up before the payment does. Number four, use DSCR as a planning tool, not just a bank requirement. This is one of those things you can review quarterly, not just when you're begging the bank for approval. So let's talk about an example, real world example here. We had one client of mine had a debt service coverage ratio of 0.95. Didn't seem like a big deal until cash got tight. The bank pulled his line of credit. Why? Because his business wasn't generating enough income to service what it already owed. So we worked the plan. We had him raise prices. He killed 2 low margin contracts he was about to start. They delayed a truck purchase, cut overhead by 15%, and 12 months later, he was at 1.6 DSCR. And the bank came back offering him more money than he actually needed. So what's the final word? This is the plain truth. If your business can't cover its debt, you're building a house of cards. It might look good while it's standing, but one gust of wind, a bad job, a slow pay, a lawsuit, and the whole thing collapses. So don't wait for the bank to tell you your ratio's too low. Know it, track it, and control it. Because if you don't serve the debt will start serving you eviction papers.